So yes, it has been a volatile start to 2021. You'll often hear us at Munro Partners here talk about the equity risk premium for markets as something that we feel can continue to drive equity markets higher from here. We show this chart quite regularly. It really looks at the premium that equities have over the 10-year interest rates and why the people will be attracted to equities over the medium term. And so as we know, most of the volatility has been caused by this backup in interest rates. This rising in interest rates has obviously compressed the equity risk premium, making markets look less attractive, and clearly making longer duration assets like growth equities look less attractive, even more so. And so from that point of view, the outlook for markets really depends on how high you think these interest rates will actually go as we move through this economic recovery. And so what we're showing you here on this slide is it appears to us is that interest rates are really being held down over a very long period of time now, or the disinflationary tendencies in interest rates are being held around by the amount of debt in the world. Clearly, as debt rose post the financial crisis, we moved to a lower band of interest rates. And clearly, as now debt rises again post-COVID around the world, we expect a lower band of interest rates. And so while interest rates backing up has obviously caused the volatility, we do struggle to see a world where interest rates can really sustainably rise much above 2.5%. And so from that point of view, we don't think this is a big risk in the long run. It's a risk in the short run as they back up, but it's not a risk in the long run. Outside of that, the other risks you can see in the marketplace are obviously some of these issues that we saw last year, like COVID coming back, or like some of the US-China issues that have obviously been developing over time. But against that, we also see these positive offsets, such as the vaccine rollout and such as the political stability we're now getting in the US. And so bringing that together, when we actually look at equity markets, we see actually a broadening in the recovery here. We think earnings will continue to grow, and that broadening rotation, while is understandable, will obviously level out once interest rates stop moving, and this broadening recovery will continue through the back half of the year. And I think this has really been confirmed finally when we look at the volatility index over a long period of time. And if you look at this volatility index over a long period of time, you can see we go through these difficult periods, such as 2008 or 2020. And what you'll find a lot of people do is they try to predict the next big bad thing that happens. But what actually happens is we move into a lower volatility band. And we've just started to see the first signs of that in the last couple of months with the VIX dropping below 20. And we ultimately think this is a precursor for really safe equity markets in the months and years ahead, and hopefully periods where we can profit for our clients.